I'm JANINA SLAWSKI. I'm Head of Investment Consulting at Alexander Forbes, and I'm going to spend some time taking you through concepts in global investing. Let's just start off with some context. Obviously, for South African investors, we generally are seeking significant allocations to offshore, essentially for diversification reasons, because there's very few counters that you can invest in South Africa, whereas you go into the international markets and your investment opportunities are vastly wider. We're obviously looking for currency hedging. Everyone expects the currency to depreciate over time. So if you invested offshore in hard currencies, then that gives you some protection. We've done some analysis of what the optimal offshore asset allocation should be. And generally, it looks to be of the order of 30%, which is obviously quite close to what's allowed outside of Africa in terms of Regulation 28 for retirement fund investors. So most South African investors will be trying to invest that maximum sort of level for as long as they're in their accumulation portfolio, maybe some sort of decrease as they approach retirement. However, it's a challenge. If you're a South African investor and you want to invest offshore, you actually have very limited choice based on locally domiciled managers. Because essentially these managers are not specialists in terms of offshore investing necessarily versus the vast international alternatives. The offerings tend to be quite vanilla. So for example, you might only be able to invest into an MSCI World or All Country World Index benchmark portfolio. You might have limited options in terms of regional and tactical allocations. And so you might have limited opportunities in terms of your ESG and impact options. And finally, your access might be difficult and it might be expensive, because obviously if there's not a huge volume, then there isn't the benefit of scale. And let's face it, the international universe is massive. Our partner internationally is Mercer, and they investigate over 6,800 managers with nearly 34,000 strategies. That is a massive universe. If you're a little South African investor, you're trying to seek an investment offshore, you really need to be convinced of a partner who can take you through these massive universes in order to give you access to the best possible mandates. But let's go into some specific global investment themes, given that you are wanting to invest in offshore and you are investing your various options. I'm going to take you through what we see are 5 currently very significant global investment themes, ranging from responsible investing as well as passive investing, disruptive assets like crypto, China also as a disruptor, and then finally, as we all know, we're entering a new world post-COVID-19. Let's start off with responsible investing. So responsible investing has for some time been a very significant trend, and it's ranged from pure allocation or avoidance of certain assets, looking for ESG strategies, and then fully going into sustainable investments, as well as seeking impact investments. This just shows you some data from the Global Sustainable Investment Review of 2020, which indicated $35.3 trillion in global sustainable investments and 35.9% total assets under management in some form of sustainability. Large allocations into sustainable investments come from United States and European investors in particular, and obviously investors such as South Africans and Africa generally, very small in terms of global figures. The trends in terms of where the assets are actually allocated, the majority of focus is on ESG integration, particularly for US investors, but also in terms of negative and exclusionary screening, and they're quite dominated by European. But the growth in these strategies has been dramatic over the last few years, particularly in ESG integration, as well as the negative and exclusionary screening. And the flows have been large. If you look at flows across both active as well as passive, they have been very significant. And this is a strong theme that's going to come through both of my initial sections. First of all, responsible investing, and then whether investors into passive investments can use their investments to be responsible as well. There are significant trends that we're seeing in the responsible investing space, and specifically focused on clients wanting more true impact investing. So traditionally, investment into ESG type investments often focuses more on the governance issues as opposed to environmental and societal. So investors want that to change. They want to actually invest into green bonds, sustainable equity strategies, and other products that actually will give direct impact on the environment or on society. And they also want more transparency. So not just a tick box that says it's an ESG positive investment, but what is the impact, how is it managed, and how can they see the development of the impact coming out over time. Investors are also increasingly recognizing the need for urgent climate action. The conference in Scotland approaching soon in terms of globally looking at whether we are doing everything that we can to meet targets, and essentially concerned that a lot more investment is needed into green investment options in order to achieve climate action. So long-term investors will be seeking to invest for impact, and specifically within the climate space. It's recognized that in order to achieve impact and climate action, it's not appropriate for individual countries to be able to do just their own projects. Cross-country collaboration is critical in order to achieve change. And we do therefore see asset managers increasingly joining these types of coalitions to drive change. Investors will also use more tools to influence companies, with ESG becoming an integral part of the stewardship role of asset managers. So not just doing proxy voting on a fairly passive basis, but actually engaging with companies and putting specific issues onto votes and using those votes to create message and certainly increasing levels of engagement. So this we really do think will influence companies and make a change. And then finally, regulatory action. Regulators see a lot of value in working with the asset management industry. Because the investments are so large, it can make such a difference. But obviously, if they're not seeing things working as well as they want, then taking action in terms of requirements and reporting, and the need for investors to take far more responsibility and be active and responsible investors. In terms of passive investing, we've known for some time that this is a very significant trend. And essentially, we've seen it continue very strongly over the last few years. On the left-hand side, you can see that significant flows have gone into passive US mutual funds, offset by significant outflows from active funds. And this is a phenomenon that we're seeing not only in the US, but across the globe. So on the right-hand side, you can see that allocations to equity ETFs have been significantly more than allocations to active equity funds. So a strong trend, which has been coming for some time, but is just continuing. We have seen significant trends in allocations towards passive away from active, with 54% of US domestic equity funds now invested passively, and 42% of non-domestic assets invested passively. This has been a trend that has been around for some time, with the overtake approximately in August of 2018, but trend significantly towards more and more passive, expected to continue into the future. But it's another strong theme that is emerging coming from passive and coinciding with the first trend that I covered, really is that you can use your passive investment to still be a responsible investor. So for example, a lot of trends towards passive assets going into ESG specific funds. So these will be funds that are based on indices that specifically overweight constituents towards those that have more positive weights in terms of ES and G. And therefore, you know that if you're investing, you're actually taking a positive stance while still potentially getting a return fairly similar to the vanilla index. So not necessarily creating issues in terms of tracking errors, but still having a very strong ESG rating. Unfortunately, this is less possible in the South African market because we have a much more concentrated list of shares, much fewer shares. So if you're going for strong ESG ratings, you potentially are ending up with something that looks nothing like the vanilla index. And then obviously you're interested in introducing some sort of tracking error. But if you're putting your money offshore and you're investing passively, then strong motivation to look for an ESG version. And a lot of providers will offer very similar or equal fees to vanilla options. So you can almost get your ESG for free if you're investing offshore. Obviously, there's other options that go further than just ESG integration and do look at excluding certain sectors or companies. As any companies involved in activities deemed unacceptable or controversial, and specifically in the climate space, moving away from dirty energy towards green energy. So very specific trends coming through, both passive as well as active in that space. And then finally, thematic filters, where companies are selected based on the exposure to specific themes like gender equality or the green economy and so on. The other side of passive investing that can also give you positives in terms of being an active owner is items like engagement with companies. Obviously, some of the largest asset managers in the world are basically passive, but they have a huge weight behind them in terms of communicating with companies, engaging them on their ESG policies, practices, etc. And obviously, they do this independently or potentially in collaboration. Proxy voting is also a massive opportunity for passive investors, even if they're not necessarily directly interacting with management, but they can look to vote proxies in a manner that advances ESG policies. So again, a very powerful use of your assets through passive, but still being very active in terms of your ownership. And then similarly, filing of shareholder resolutions on ESG issues. That's becoming more and more common in the South African market, specifically in respect of climate change issues, and similarly in the international space. Strong focus on shareholder resolutions, active ownership, and trying to lead to positive outcomes. So those are the first two themes, very much focused on responsible investing, using your passive assets if you're investing passively to similarly be a responsible investor, and overall seeking ways to use client assets to give us a better future. The next one I'll look at is the disruptor, crypto assets. We often look at this as an alternative to traditional currencies, but also in terms of alternative to gold. Gold for some time has obviously been seen as an alternative currency, a good inflation hedge, etc. And now we've seen a huge disruptor coming in the form of the crypto assets. There are literally thousands. The CoinGecko tracks over 6,600, and there are several with market caps over $1 billion in dollars, with at least 7 different types of high-level categories within the crypto assets markets. Internationally, looking at something like 50 million active crypto traders, 25 million active economic wallets, and a huge level of popularity among some nations. So where you have a high inflation environment, it's excellent to have a cryptocurrency that is unlinked to your own currency and obviously gives you the ability to move across the world. So for example, 32% of Nigerians own crypto and 16% of Turkish people also earn crypto assets. But one of the key underlyings to these crypto assets is actually blockchain technology. So this is a decentralized network with essentially no central authority and your system of peers who approves every transaction. And because every peer has a copy of the transaction ledger, it's very hard to falsify. So blockchain is actually a massive technology shift, which will change traditional banking, transactions, etc. But obviously is the key behind the security of the crypto assets that has led to their significant popularity. Crypto assets actually arose originally out of the ashes of the global financial crisis and a lot of distrust of some of the more traditional regulatory and currency networks, but a significant change in terms of the way we manage money going forward. Essentially, Bitcoin has been the dominant out of the cryptocurrencies, certainly leading other alternatives. Ether also a significance, but then a mass of others coming up in terms of different options. And essentially, at this stage, cryptocurrencies have a market cap about the same size as the US small cap stock as measured by the Russell 2000. So certainly still small compared to other traditional currencies, particularly the US dollar, but becoming a really significant portion of allocations and potentially being an alternative disruptor, and particularly as an alternative potentially to gold. If you do look at what the returns have been over the last couple of years, obviously they've been extremely positive. And that has led to a lot more interest from investors. Access is getting easier and easier. Although in some markets, and specifically China, there are significant clampdowns. And you do have someone like Elon Musk creating a market for crypto and then going against it and back again sort of thing because of the environmental challenges. And these are certainly significant. And in terms of the responsible investing issues, these are significant when it comes to crypto assets. And therefore, even on this basis, a lot of investors will not want to invest into crypto assets, even if other of their characteristics are positive. First of all, there's always been a lot of concern around criminality and Bitcoin, essentially because they're not traditionally parts of regulatory environments. It does mean that investors can move assets easily, particularly between different countries using cryptocurrencies. However, over time, the regulation and law enforcement has been catching up. So the level of use of crypto assets for criminal purposes has been reducing. And similarly, the cases of laundering through cryptocurrencies is relatively small compared to volumes of cash that are moving. The other major issue for crypto assets is the energy that is used in crypto mining. And just to give you a sense of how significant it is, one Bitcoin transaction requires the same energy as processing 1.2 million Visa transactions, watching more than 90,000 hours of YouTube, and 39 days of US households' energy consumption. So very significant. Carbon footprints almost 6 times that of gold's. And when you consider that gold is mined, it does give an indication of the order of magnitude. And unfortunately, only 39% of power coming from renewables, and therefore causing a lot of the dirty energy issues to be escalated. So how much of a disruptor are crypto assets? Is it really a source of valid strategic and long-term asset allocations, or is it just a sideshow? Especially if you go through some of the key items you're looking for in a currency or an asset class, you do want it to be a store of value, but essentially the only plausible case for Bitcoin is as a form of digital gold or store of value, because there's nothing underlying it other than the ability to buy and sell between other people who believe that it has value. And obviously gold has always performed that function and has a long track record in the space. It's also a source of asymmetry because there are other transformational assets that generate revenue and that can benefit from the way we know the world will change, whereas Bitcoin doesn't actually produce any revenue. Is it a hedge against other currencies? There is concern about the value of currencies debasing, but there are obviously alternatives to hedge this risk. And crypto assets themselves are subject to substitution. And then finally, we have at least the crypto assets are not likely to become a significant replacement in the payment space, generally inefficient and impractical, although this may change. So at this stage, we certainly don't see major allocations from investors into crypto assets, although it is something that we watch, and this could change over time. Then coming on to other disruptors in our markets, specifically China. This is definitely a big topic for South African investors. Obviously, our biggest shares, including Naspers and Process, are significantly influenced by what happens with Tencent. And generally, as a commodity economy, we're very influenced by what happens in China and whether they are buying our commodities, what investments they're doing into Africa, etc. So very closely watching what happens in China, and particularly with the recent regulatory changes and the crackdowns on the gaming and generally in terms of the tech companies and online education providers. China has historically been growing its GDP significantly and growing more and more in significance as compared to the US, and certainly forecasted in the next few years to potentially overtake the US. However, they've significantly underrepresented in global indices. So essentially, if you look currently within emerging markets, there's currently only a limited allocation into China. Only 20% of shares are included. Even at that level, you end up with 34% offshore and 5% onshore, being the mainly A shares. But if you included them fully, then across both offshore and onshore, you actually would be getting to almost 50% just within emerging markets. So this does indicate that if you as an investor are allocating to a vanilla emerging market type portfolio, you're significantly underrepresented in terms of China allocations versus actual underlying economy. China onshare is also significantly more diversified because the offshore tend to be more traditionals that international investors have invested into, whereas onshore is really giving you access to the Chinese story, particularly in terms of consumer staples and healthcare. So both China and emerging markets should actually be a much larger share of the MSCI All Country World Index. The old world that we live in today has approximately 88% of this invested into developed markets, only 12% in emerging markets, of which onshore China is only 0.6%. In a new world where you actually included China at its correct level in terms of 100% of its indexes or stock markets, developed markets would drop to more like 75%, emerging markets would grow to 17 to 25%, and onshore China would be a dramatically larger 5 to 10%. And that is where a lot of the growth is expected to come in terms of China as they bring more and more of their population currently at lower levels into better economic territory. And this is therefore a significant investment opportunity potentially for us. As an international investor, if you're looking to allocate to emerging markets, China, right now your options will tend to focus around either passive emerging markets or active, but benchmarked to something like the MSCI emerging markets, and therefore still very underweight China. More and more investors are now actually doing a carve out so that they're allocating to a specific onshore China capability alongside their active. So that obviously gives you a positive tilt toward China, but still potentially underweight where China actually fits within emerging markets. But going forward, we do believe China will come into its own. So long before it ends up fully included within the emerging market indices, we do see clients allocating significant portions so that they're starting to more match the underlying GDP type allocations as opposed to those in the indices. So we've looked at responsible investing, passive investing, and then some disruptors that are very different to where we used to be, where we had the introduction of crypto assets, as well as looking at what's happening in China. But now we talk about what's happening post the COVID-19 pandemic. Obviously, this has been a dramatic impact on the world and has changed the way we look at certain companies, industries, and trying to work out which ones are going to be the best investments for the future. Now, there's been a lot of talk about what could be happening in the next few years post-COVID. Obviously, a lot of discussion about the potential for inflation, the fact that the central banks have now built up dramatic balance sheets, that tapering of quantitative easing has to come through, interest rates must go up, and what are we going to see in terms of the different industries that did well post the COVID-19 pandemic? Are they still going to continue to do well? So just some key themes that we see emerging and that we're watching over the next few years. First of all, markets have obviously run very hard, and we do think that there's an end of the great party that we've been having in the last 12 months. So we do think markets will move more sideways. Although economic recovery is likely to continue, markets could move sideways because the stimulus will lift economies, but could also revive inflation and raise bond yields. The surge in savings, which drove a lot of the increase over the last 12 months, is not going to necessarily be able to continue. And obviously the pandemic's end is already priced into record high valuations. The big topic has been inflation, with 4 factors, we call them the 4Ds, threatening to revive inflation. Specifically depopulation in terms of growth in global working age populations falling, deglobalization, given slumps in global trades since the 2008 global financial crisis, but obviously continuing with trade wars as well as now challenges during COVID. Declining productivity, partly driven by governments bailing out unproductive companies. And then finally, debt, with significant rises in government debt, including the trillions paid for pandemic stimulus packages. Housing has been in demand, essentially with inflation booming, investors turn to traditional hedges and including specifically housing. Easy money certainly has to dry up, and we do expect this to happen initially more in terms of reduced bond buying, but eventually in terms of increase in interest rates. Obviously, that is a challenge, at least for South Africa. The higher the international interest rates, the more vulnerable is our rands, because investors can invest internationally and not take the risks of coming into South African assets. We do see changes in currencies going forwards, not quite yet predicting a post-dollar world, but we have been surprised by the emergence of particularly Bitcoin and other cryptocurrencies, and there will definitely be changes in the way that international investors view the various currencies. Commodity prices have obviously had an extremely good 12 months, but have been declining steadily in real terms for an extended period. The long decline is punctuated by occasional booms, and that is possible over the next few years. We do see reasons for an emerging market comeback. Obviously, emerging markets have struggled, especially over COVID, but commodity prices could drive a recovery. Some emerging countries are still growing significantly. A lot of emerging markets are looking to market-friendly economic reforms forced on them because of the financial distress during COVID, and also the adoption of internet technology, again, driven by COVID. It is rather stark that the top emerging markets account for 36% of global GDP, but just 12% of global stock markets. And obviously China, a significant underweight, as well as we've shown in terms of passive investments and allocations. Certainly imbalances like this will have to come right over time. Then the digital revolution advancing rapidly due to lack of existing infrastructure, and therefore the need to significantly adopt digital. And then finally, rising challenges. So the e-commerce giants have made huge gains, but the market caps of those smaller, faster growing companies are starting to be significant. And we know that post the pandemic, media habits have changed, which is changing online entertainment and generally the access to tech options. That concludes my presentation. I've taken you through a realm of potential themes for you to look at as you allocate your assets internationally. But as I said, it is a challenge to decide how much you want to invest, particularly within your SARB limits. You need to partner with someone who can give you deep manager research, access to good implementation opportunities, and on a cost-efficient basis. So good luck with your global investing, and thank you very much for spending time with me today.